and the inverse head and shoulders, or inverted head strokes for different folks on what you would like to call it. There is an easy way to explain it. You know, there's the textbook way, which would have every single one of them ever on the head and shoulders, giving you a rise, giving you the fall, giving you a higher high, more than likely coming right back into a double bottom, going back and giving you a lower high at a point that's equal to the high before the higher high, and gaining a severe degree of momentum when it fails what is called the neckline. Now, the way we would label this out, we would have left shoulder, we would have the head, we would have the right shoulder, and we would have the neckline. It's really simple. Why do they call it a head and shoulders pattern? Because it almost resembles a guy standing there where you got the two shoulders and the head. It doesn't need to be made into a difficult obstacle. It's very, very simple to understand. Now, this pattern in particular does not become a confirmed pattern until the breakdown of the neckline. But just like we talked about with the W pattern, and just like we talked about with the wedge patterns, there are times you can make smaller buys to prepare yourself for the more momentous trade. Where do you think we would look at a potential smaller entry, like that 1/3 entry I like to do? Where would we look at making that 1/3 entry on a short trade in anticipation for a head and shoulders play? Yeah, we would look right in here at that 1/3 buy, because the pattern's not confirmed until it makes that breakdown, which means it's a much riskier trade at that point. Much riskier trade. And once we have the pattern confirmed, by making the smaller buy when it's riskier, the larger buy when it's confirmed but has obviously already dropped some, it gives us a lower average on our larger buy, which means even on the stop out, which would be a rise back above that neckline, we're not going to lose money, right? That's a very, very important thing to look at. Some people get too enthralled in the aspect of, oh, it's a green candle today, or it's a red candle today, or on the 1 minute chart especially, and letting that dictate their emotions. But when you look at the proper approach at making certain trades and planning certain trades, you will have a greater level of success in understanding what it is you're looking at and properly preparing for the trades on that. Well, we would buy into a short position. That's a good question. When we talk about buying, it's not necessarily to go long, you know, to buy common shares or whatever for the stock to go up. We would make the buy on our positions. We would make the buy on a short in anticipation for the stock to fall. And the reason we'd want to make that smaller buy up at the top of that right shoulder when it's an unconfirmed pattern is because so long as it's an unconfirmed pattern, it's a risky trade. And let's face it, if we have less money in it, we can lose less money. And risk management should always be a priority. Now, the twisted sister for this would be the inverted Head and Shoulders. Let's go ahead and show that one. The inverted Head and Shoulders would start off with a drop. You'd come up and many times either get a double top, sometimes a lower high, that leads to a lower low, runs right back in that general vicinity. Now, granted, I'm showing you the textbook version. I don't care what you do for a living. You've got the textbook version and you've got the real life application. They're not always the same, but you got to learn that textbook version before you can really start making progress. You would get another drop here that would be at or equal to, somewhat visibly equal to, whoops, didn't mean to change that color. That would be visibly equal to the low before the lower low. In this particular pattern, where the Head and Shoulders is considered the most bullish or most bearish of chart patterns, the inverted or inverse Head and Shoulders is widely considered to be the most bearish. In this case, see, this is where some people get some things confused. Believe it or not, this would be the right shoulder. Why? Because the dude's standing on his head. I won't make you do an exercise where you stand on your head and take a picture and send it to me, but I'm sure you can see this. And let me get the arrow tool. Places we would look to make the buy would be the smaller buy on the higher low, i.e. the left shoulder. And I know I didn't draw that top line too parallel. So let me delete that. Make me delete the whole thing without. So anyway, we would be looking for the 1/3 buy here, and this would be for the long entry, and the 2/3 buy here. And if you didn't want to take the extra risk on the 1/3 buy and you simply wanted to trade for momentum, you could just buy the entire position once the pattern is confirmed. Many times this will play out looking just like an ascending triangle. A lot of people don't notice the inverted Head and Shoulders when they're trading ascending triangles. And then they wonder, wow, how come that one did so good and the other ones just do kind of good? Well, when you get that inverted Head and Shoulders, that makes a huge, huge difference. So let's take this off of here and let's go look at a couple actual applications of where we could be looking to need to prepare for a Head and Shoulders play. I'm going to start out with the RUT chart. It's the Russell 2000 chart. You see I've already got this chart marked up. The left shoulder, a higher high that was the head, the double bottom area, which presents my neckline, and our high right here, as of right now, which is indicating our right shoulder. Does everybody see how, though that doesn't directly resemble my drawing, that is a potential setup for a Head and Shoulders? Can everybody see that? If not, let's discuss it so we can answer questions. I don't want you to have questions. So if we were looking at the setup trade for this, the setup trade would come where we could have gone short over here. And would we go in with a full position over here? Is this going to be like short and a full position? slinging 10% of our portfolio, just ready to lose it all? No. This would be, about a 1/3 buy, a small buy, right? And we wouldn't get real heavy into it until we got a close. You notice I've got some prices below there. I go on closing prices. Why do I go on closing prices? Well, let's face it. Stock market's open for 6.5 hours. And for the other 17.5 hours of the day, the price that goes across every TV screen, every computer monitor, is the closing price. That's the price that matters. When you look tomorrow at how much a stock is up or down, it's up or down based on yesterday's close. Or today's close in that case. So the closing price is what I'm concerned with. So if it were to close below the line, then you would have the momentum type trade. But had you bought the smaller entry here or here, you allow yourself a much lower average in the trade for the time when it does break out or break down. Now also, because you'd be up here trading an unconfirmed chart pattern, literally in anticipation of a specific chart pattern, because right now it is nothing other than potential, you'd want to go smaller because there's no greater likelihood of you being right. There's no greater likelihood of this going down than there is of it going up right now. There really isn't. So you'd want to have that smaller entry in case you have to stop out. And where would you stop out? Well, if it closed the day above this purple line right here, you would no longer have validation of a head and shoulders pattern. Very, very simple. You see, recently, we actually had a head and shoulders that played out very, very well on the first buy, but never gave us the confirmation. You see Netflix. Everybody see the left shoulder over here on Netflix? Everybody see the head on Netflix? And did we see right here the right shoulder being made? Does everybody see that? Well, the anticipation buy on Netflix would have been a smaller dollar amount that you've put into the trade, and one of two things from this point. Some people would have held, let it bounce, then hey, as long as it stays within this channel, we would stay short on the head and shoulders. So in that case, they could have got out with, basically a break-even trade when it broke above, or minimal loss when it broke back above that line on a smaller position. Some people would have saw it bounce here, might not have sold, saw it bounce here, and might have considered selling, but only have been in the 1/3 position. Somebody look at this chart and tell me what happened twice on Netflix's daily chart before it confirmed the bearish chart pattern of a head and shoulders. It gave you two bullish patterns to wipe it all out. What were the two bullish patterns? Let me take the drawings off here. Okay. You got a W here, right? What did it do? It essentially, not textbook, but real life application here. That's pretty darn close to double bottom. It gave the W breakout. It never closed below the price. In comes momentum. And in all honesty, you probably would have sold out of the trade right here because your volume died off. Still would have been a heck of a trade. But do you notice we never got that neckline failure, which would have been right here congruent with my horizontal crosshair line. So we never had the actual confirmation of the head and shoulders. It was only potential to that point. Do you guys see the second bullish chart pattern that happened? Second bullish chart pattern that took place. We had the W here, from this bottom. Went off my lowest close. Here we go. There's the W. Retested it. Boom. What else did we have? We had another W, didn't we? Why am I putting it at the bottom of this candle body? I put them on the highest close. A red candle body indicates the bottom of the candle body is the closing price. But it made the W the second time, didn't it? It broke out right here. Look at your big volume spike too on your breakout. Boom! And we know from our lesson on that our target on the W breakout is the first close at the start of the pullback. Looks like it almost hit that target today. Right? Where do we buy a W? When it breaks out or when it does what? When it breaks out or when, there you go, on the retest of it. And we can say that with a lot of confidence because we see this pattern break out and retest all the time. All the time. To the point where, we demonstrate these in the chat room all the time. And it's like, okay, even on intraday charts, you got the breakout. If you missed it, well, just wait. It's going to retest it. And you're like, no, it's not. It's going to keep going. No, it's not. No, it's not. I'm telling you, it's going to keep going. And then you look back at it and say, oh, crap, it did retest it. Now, I want you to look at Netflix here for the potential pattern the retest of the W would give you. I want you to pretend something real quick. It's going to be a neckline. This would be the right shoulder. This would be the head. In a retest down in the area of this W, would it not give you an inverted head and shoulders? How does a good inverted head and shoulders play out? Well, let me take you back to a little time in history. Little time in history. And I'm going to zoom in this chart a little bit. I'm going to go back and we're just going to walk through this trade. Hopefully it'll let me zoom back enough. Okay, so we're going to look back in November on Facebook. I'm going to mark out a neckline. I'm going to mark out a left shoulder, or a right shoulder, sorry. I'm going to mark out a head. You see, through this time, we made the drop. Actually, the shoulder would have been over here. I'm sorry about that. We've got the shoulder, the return to the neckline, the drop into the head, the return to the neckline, and you've actually got a smaller inverted head and shoulders right here, if you can see it. Here and here. Once you keep watching here. On this breakout, this is where you've got the confirmation of the inverted head and shoulders. At which point your buy is here, but remember there's this little head and shoulders down here, or inverted head and shoulders here. at which as a result of an inverted head and shoulders. I talk about that trick because I actually made that one on the inverted head and shoulders. Except for I sold out a little too soon like a sissy. But nobody ever goes broke selling too soon. Believe it or not, with the fall, the lower low here, and shoulders here and here, and a neckline across the consolidation, you actually had a similar breakout a couple weeks ago on Facebook again. I want to take a look at a couple potentials of what to watch for possibilities. Now, this isn't saying, oh yeah, let's get ready to short these charts. I want to make sure you understand that. I'm not saying let's get ready to short these charts. I'm saying let's watch for what they're actually doing, and let's identify the fact that we have a head here. We have our shoulder here, and we have a clearly defined neckline, don't we? Does everybody see that? Can everybody see the clear definition? Left shoulder, head, right shoulder. When would this chart pattern actually be confirmed as a severely bearish chart pattern? What would it have to do? Yeah, it's going to fall down here. But in this case, that's like a $10 fall. This would be like a $10 fall down to here. So where would you look to potentially enter this? Not necessarily going to be today, but let's say tomorrow pulls back without breaking above that line. Would we take a big entry in a short? I mean, are we just going to load the boat, bet the farm, take out a second mortgage, borrow money from grandma? Maybe knock grandma off so we get our entitlement or whatever the heck it is? No. A 1/3 buy. Why? Because until the chart pattern's confirmed, it's a shot in the dark. And if we are wrong, we'll take a smaller loss in being wrong. Don't ever let anybody fool you. You're going to make losing trades as a trader. No trader in the history of the world that has done more than 1, 2, maybe 10 trades has not had a losing trade. Learning how and why to manage your risk is going to be what gives you longevity. But let's just assume that tomorrow gives us a pullback. Or maybe we just kind of have a flat day, and then Thursday gives us like an evening star, which would be another bearish chart pattern that we've talked about previously. A little 1/3 entry. I mean, let's think about it. If I take a 1/3 entry in puts, I could lose 100% of that puts play and still only be down 33 1/3% on an entire position, right? You guys see how I'm getting that number? And we all know that on an options trade, if you don't get 100% profit, don't talk about it because you didn't do that good. So 33 1/3% loss isn't a bad deal. And that's the max loss. If you just stop out of the trade where the line is on your chart that tells you to sell it, if it goes above there, you wouldn't lose that whole amount. Where would we look at the 2/3 buy to get the full position? A breakdown below this line. What would we need to do in anticipation of a breakdown of that line? Are we going to want to buy $48 puts when it's at $48? I mean, we could take in the money, but they're going to be less volatile. Typically, with the wanting the high volatility, you're trading out of the money. So are you really going to be looking at $48 puts for your 2/3 buy? No. So you probably don't even want to look at those up here. But what are you going to have to allow yourself if for some reason Salesforce.com does pull back over the next couple of days without breaking above this horizontal line? What do you need to allow yourself to not screw yourself over? And I guess the answer I'm looking for, there you go, Craig's got it, time. Because there's nothing worse than being in a calls play, watching your stock go up and you still losing money, or watching your stock go down, you being a puts play and still losing money because you didn't allow yourself enough time or play the proper strike. If you were trading for a breakdown in anticipation on a head and shoulders, your target area is going to be this consolidation range from before it even broke out. And you're going to have to give yourself a lot of time in preparation for that play. You could just go sideways for quite a long time in this horizontal $10 channel. When I look at ones like these, if I were making this anticipation play, I would have no problem playing a $40 put. That $40 put, though, for me, would be taken probably at least the November monthly. If I bought it on the ask, it cost me $58 right now. But you know what? Come time that it actually fails below here, that $40 put would then probably cost me around $200. Well, let's look at something. Let's assume that $1,000 is my total planned position size. And I'm going in with a 1/3 buy. Well, luckily, even though I'm putting less money in it, I can buy a lot more contracts. I can get me 5, almost 6 contracts up here. You know, 5 contracts at 58, $290. Take my $1,000, subtract $290, and then at the time where I know I'm going to pay about $200 a contract, if it fails that, I'm only going to get about 3 of those. What's that going to say about my average when I bought more contracts at a lower price than I'm buying at the higher price? My average is going to be quite favorable, right? Well, the average will move up from the original buy, but if I buy it on the breakdown of the neckline, and let's just talk common share price to make it easy with the explanation. If I went short now at $58, we'll say, and then I went short again at $48, enlarged my position, when I get this short here, my average is going to be more like here, right? Even when I make that second buy. And if at that time, this line that it's failing below is my stop, and my average is halfway between these two lines, if I need to stop out of the trade, based on my average, what kind of money would I be losing? The answer is it'd still be a winning trade. It might have failed on your second buy, but it would still be a winning trade. But for this type of pattern, if you're making the anticipation buy, you got to start smaller and you got to be further out if you're looking at the options. Now, what happens if we come out tomorrow and it closes above this line? Let's say it comes up and closes at 60 bucks. What do we do with all these drawings on our chart? Well, I'm talking about before we even buy. Right now, I'm saying we can anticipate a buy. We can plan a buy. But what do we do tomorrow if it closes up above this line? We delete the lines and say, oh, we were wrong. We don't need those lines on the chart because they would no longer matter. Move on, look for another trade, maybe even look for another trade on the same chart. You know, I'm a big advocate of the fact that nobody can trade every single chart in the stock market. So you need to pick a small group of them and trade them well. I already showed the Russell 2000, which we could trade the IWM, which is the ETF. You see the same pattern. Same potential to the head and shoulders. We could plan a potential head and shoulders type trade off of that. URZ, Uranium Energy Corp. We got a really ugly pre-failure of the neckline, but remember what we talked about. There's textbook application and there's real life application. We still have shoulder, head, real close to that right shoulder. Real close to that right shoulder. Or ironically, was this the left shoulder? And is this the neckline? And uranium right now is not a good place to be. It was for a while. Not a good place to be right now. So a couple potential bearish looks on some charts. Now, we can use these intraday as well. When we say intraday, that means during the day. And one chart I like to day trade a lot is Facebook. Facebook made a head and shoulders twice today. You got left shoulder, formed your neckline, head. The right shoulder, look at the wick, came right up to your highest close, right there. You got the failure. This would have been a quick put scalp. But then look over here. Left shoulder, neckline, head, right shoulder, failure. Do you see that? Also, I like the M on this. M's and W's are very lucrative on Facebook as well. See the M went up, higher low, double top. Here was the breakdown of the center of the M. Boom. Volume spike, big candle. Look where it retested. Didn't close the candle, back above the center of the M. And it fell again. And then the M pattern led into a head and shoulders pattern. Does everybody see that easily enough on my chart? It's not always the textbook version. Have you guys ever worked a job and, I worked in electronics in the Navy. I did electronics outside of the Navy. And I would go to school and read this manual that said, this is exactly how electronics work. And then I would get out into the field and they never worked like the book said. You guys ever been in a situation like that? Have you ever been a mechanic? Have you ever worked on anything? You ever put together a piece of furniture from IKEA and the directions say, this is how it's going to look when you put it together, and it doesn't do it like it says it's going to do it, there's a difference in the textbook application and the real life application. We go on visible similarities. And one thing you'll always hear me say is that you need to interact with your charts. The reason you need to interact with your charts, there's two questions every trader always asks me. Anybody know what they are? Probably the same two questions you always have. Yeah, when do I buy? When do I sell? Interact with your charts. Recognize the chart patterns. Draw some simple lines on your charts, because these lines on your charts tell you where to buy and they tell you where to sell. Let me show you how. I'm going to unsynchronize my drawings with Thinkorswim so I can delete them. And as you're watching Facebook intraday today, you would be looking at, okay, whoa, crap, it's doing, wow, this is kind of funky. Man, that's kind of, okay, now I'm up here with my highest close. Whoa, I kind of got a drop. Now it's going up. Man, that about hit that line. I could take a preemptive buy in puts right here just in case it ends up as a head and shoulders, or I can wait until the, boom, oh crap, now it's coming. It really stopped me out right back where I was. So either I got the quick little scalp trade on it, or I was at about break even here. Time goes on during the day. You're sitting there watching. Two lines I always have on my chart: the lowest close and the highest close. Those will always be on my chart. And now I come up here. Okay, I made a high. Now I start pulling back. Yeah, this is almost a double bottom right here. Okay, and almost a triple bottom right here. And okay, that went up, and ooh, hold on a second. Comes back in here. I've got an M. Ooh, yeah, I've definitely got an M I can be looking at here. Definitely got an M. And on the breakdown right here, I take the puts position. Where would I stop out? On a close, back above this line. It didn't do it. Then it starts dropping again to this line. I'm like, whoa, hold on a second. That's a neckline, that's a head, that's a left shoulder, that's a right shoulder. I can buy more of those. Where would my stop be? Right back here at this line. But if we were day trading it, our stop would have been the end of the day, right? Our stop would have been the end of the day. Because if we were day trading options that expired this week, we don't still want those tomorrow, because the risk always outweighs the reward of holding something that close to the expiration overnight. But you have to interact with your charts. And we've got several video lessons. I don't just go over candle patterns and chart patterns. I'm primarily a Fibonacci trader. A lot of Sneeb in here primarily uses channels. I like to use swing points as well. And when it all comes down to it, the trading system itself allows you to answer the question, when do I buy, when do I sell? Well, Kim, and that's a good thing to say, but every trade, every pattern that presents itself, not every trade is a long-term investment. And not every trade is a day trade. You don't go long-term in a puts play on a 5-minute chart's head and shoulders. And you don't go short-term in a calls play On a daily chart's inverted head and shoulders breakout because you're selling yourself short. Well, if you're trading off a 5-minute chart, you're trading options that expire the same week you're trading in. If you're trading on a 15-minute chart, you're still trading within that same week. If you're trading on a 60-minute chart, you're usually trading the next week or 2 weeks out. If you're trading on a daily chart, I generally like to trade 6 to 8 weeks out. And if I'm trading on something I see on the weekly chart, I like to trade 4 to 6 months out. That allows me to let the time that it takes to make the moves that it does, it allows me the time to let those happen. Because, let's face it, over here on Facebook, July of last year, if I would have only entered that as a day trade, bought it, sold it the same day, I sold myself short, didn't I? Or if I would have entered it on like the next week's expiration, I'll just see if it goes up a little bit on the weekly chart. Even back to this point here when it broke ascending triangle, you see it? Higher lows. You have a horizontal right here. This candle broke it. And I'm on a weekly chart. If I'm only trading out 6 to 8 weeks, 1, 2, 3, 4, 5, 6, 7, 8 weeks, I've got it. I'm done here. If I'm trading out 4 to 6 months, I saw the top. Well, and Leonard, that's a very good point. Leonard's saying it's easy for me, but to think in multiple time frames, time ranges is difficult. It gets confusing. That's why I use a setup like this. Okay? In using this setup, I've got my daily chart, and I'll make trades based on what the daily chart shows me. And I've got a 60-minute chart, and I'll make trades based on what the 60-minute chart shows me. 5 that I use in conjunction with each other, and I'll trade in accordance to what this one shows me. That does mean that there will be times where I'm in a long play based off my daily chart. I might be in a short play from my 60-minute chart, and I might be in a short play from my intraday charts. And you're very right about that, Kim. I mean, I won't avoid any question. But what you have here is you have the opportunity to study less charts, to watch less charts, and make more trades, and give yourself better leveraging opportunities, which is what we talk about doing with our focus group. Because it allows us to watch less, make the trades, give ourselves a little bit of protection. Kind of like what I said in my email alert today on Facebook. I'm set up now primarily to the long side. My day trades, I will only look for short opportunities for day trades on Facebook. Because now that provides my leveraging. I'm in calls go up, price goes up, calls go up, price goes up, calls go up, and then it starts going down. My calls are going to go down, and then everybody wants to freak out. Oh, should I sell? Well, you know what? I'm trading out in August. I'm trading in July. No, I shouldn't sell. I should take a short-term puts play, make money on that, and say, hey, because I made profit on that, I didn't lose any money on this. The other cool thing about that is if I lose money on the short-term trade, that means I made money over here. And I've always been one that had a greater focus on long-term trading to the upside, short-term trading to the downside. Sadly, the past 2-3 months have made me kind of have to do the opposite. Just over the past 2 to 3 weeks, charts that had fallen and fallen and fallen started making higher highs and higher lows. put me back in my zone. So now I'm ready. I'm waiting for a couple things to come down to start making action or taking action. You guys have seen a few alerts come off of those already. Not just with the focus group, but just with the general alerts as well. But to trade off the multiple time frames, it's not as hard as you think. I thought it was hard when I was first taught to do that. How the heck do you do all that? And I made the mistake. I'd be day trading a calls trade and a soon trade. I would sell all my swing trades too. Only to find out it barely even pulled back and I should have still held them. But I can tell you this much. It's a lot easier to have 3 to 5 trades open at one time on Facebook and just stare at this one screen than have 3 to 5 trades open on 3 to 5 charts and be jumping all over the place. Rephrase your question if you don't mind. If a day chart breaks a long channel, you mean a daily chart? Well, if it retests a support, or like in the example of Goldman Sachs. Let me go to Goldman Sachs over here. This will be a good example. In the event where Goldman Sachs was in a down channel and it broke above that, am I kind of in line with what? You go long on the break. Initially, your stop is that channel line, but that channel line is going down, right? You don't want your stop to go further away from you. When you can recognize a point of consolidation, like what I have right here, on the breakout, your stop becomes the swing high. Because that should be all it retests. You've actually, believe it or not, this is like an ascending triangle, where all of these are that horizontal top. It broke above that. So now I can take out this line. This line's not my stop anymore. I went from a downwards moving line, a descending line, to a horizontal. That's a progression right there. And once I can establish something better, maybe this, I can dictate my stop a lot easier now, can't I? And I can set a little broker alert, just right click it, create alert withdrawing, crosses below, and I can type in, sell them calls. Put some exclamation points. It'll get emailed to me. But this is why you need to interact with your charts, as opposed to what a lot of people do. And I'll show you a good example of what a lot of people do, and I don't mean it to be disrespectful. I mean it to be an opportunity for you to learn from it, because I just know for a fact this is what a lot of people do. They'll look at a chart like this with all this crap on it that they don't even know what the crap means, and there's so much of it that they don't even know where they should buy or sell. And they don't have any drawings on it because, I've already got enough crap on the chart. I don't need any drawings getting in my way. Here, they just sit here and do this. I'm watching. There's a green one. Oh, there's another green one. Oh, there's a red one. Hey, there's a green one. I like green ones. And here we go. And I don't know what any of this means. But there's green and red. I like Christmas. Oh, there's a big green one, and that made my account go up. I like that one. But they don't know what they're doing with it. Don't watch your charts. Interact with your charts. And that's what me and Sneeb and Coach John and Coach Henry, it's what we do all day, every day here. all day, every day, we've got these charts up on the desktop sharing. We're going over potential and, hey, I think if it does this, you've got to trade this way and here would be your stop and blah, 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 blah. You've got